Did you know September is historically the worst month for stocks? But why? Why is September bad for markets? And most importantly, what does this mean for you and for your portfolio? My name is Nick, and I'm a former financial advisor. I'm the co-author of the book, The Quick Start Guide to Investing. And at 42, I retired and I'm living full-time off my options trades and a small dividend portfolio. Today we're diving into the September effect, a quirky stock market trend that has been around for nearly a century. In this video, I'm going to break down what is the September effect. We're going to look at historical data, we're going to visualize trends with some charts, and we're going to explore why does this happen. And then hopefully I'll find some actionable insights for your portfolio. So stick around for the full video because at the end, I'm going to share my plan heading into September.
Welcome to 15 Minute Money, the show where I search the financial world for the most up-to-date investment ideas, market trends, and income streams so you don't have to. I'm your host, Nick Bradley. Let's get into it.
So what exactly is the September effect? It's, well, the historical tendencies for stock markets, especially the S&P 500, to underperform in September. Other months, you don't really have to worry about. September, you got to bank on bad returns. And this pattern goes back to 1928, and the numbers, well, they tell the story. Check this out. Since 1928, the S&P has averaged a negative 1.2% return in September. It's the only month that is consistently negative. Around 60% of September's finished negative. And it's not just the S&P. Other indices like the Dow Jones Industrial Average is down 1.1%. The NASDAQ Composite down 0.9%. To put this into perspective, let's look at this chart. You can see September stands out like a sore thumb. But why does this happen? And what about more recent years? Perhaps we should dig a little deeper. Let's break down the numbers. Since 1928, the SPY's September return, again, negative 1.2, with only 44% of September's closing positive. The Dow Jones, even worse, only 41%. The NASDAQ, they do a little bit better, 54%, but that's since 1971. Now, let's zoom in on the last 5 years, 2019 to 2024. September's have been rough, an average negative 3.15%. 2019 saved us a little bit. Then we had 4 years negative in a row. Only last year, 2024, saved us from a 5-year slide. So the data's clear. September is tough. But what is driving this? Let's find out. There's no particular reason why September struggles, but here are some factors. First, portfolio rebalancing. Big institutional investors and mutual funds often sell underperforming stocks at the end of the third quarter to make their portfolios, look a little better. It's called window dressing, and I think it's gross. Advisors dumping on the market, looking busy, so that way the next time you talk with your advisor, like, hey, Bill, how's the portfolio? He can be like, oh yeah, I'm working really hard for you. This is why, for the most part, I'm in favor of people investing for themselves. Either low-cost index funds, or if you're up to it, individual stocks. Why pay a broker thousands of dollars a year for most likely to underperform the S&P 500? Okay, second reason, trading volumes surge in September. Traders return from their summer vacations in the Hamptons, and lots of traders are doing buying and selling, and that means lots of volatility. Third, investor psychology. After a relaxed summer, bad news can hit harder, and this leads to overreactions. Then, on top of that, September often overlaps with big events like a Fed Reserve meeting. For example, last year, September 18th, the FOMC meeting stirred markets, and uncertainty makes markets jittery. You gotta remember, the markets are just people, and people get jittery, and people make bad decisions. This volatility chart on the VIX shows the fear index. It's often spiking in September. But here's the catch. While these factors contribute, they don't guarantee a bad September every year. Past performance isn't necessarily a crystal ball. However, history often rhymes. So keep in mind, not everything tanks in September. Since 1990, there were some positive returns. Gold and precious metals topping the list at 1.4%, insurance up 0.7%, personal services up 0.6%, and oil and healthcare both landing at 0.5% positive. So what can you do? To answer that, you need to identify, are you a long-term investor or a short-term trader? If you're a long-term investor, number one, buy the dip. Buying the dip long-term has proven to gain wealth. Listen to Tom Lee here talking about buying the dip. And by the way, this interview was last September.
Positive returns for buying the 10% dip strategy since 2010. It's a 100% hit ratio, of course, but like just the trend in how much easier it's gotten to just automatically buy that 10% dip.
Yeah.
And So, Tom, to some extent, when I saw this, I thought of you because you have been the guy consistently. Every time there's a dip, you're not telling a different story. You're saying this is when you want to buy.
Yes.
And it's so simple. And it seems like everyone should know that. They don't know that, or they're afraid to say it, or some combination of the two. Do you agree with me that that's kind of like become your persona?
Yes, I'm employing Einstein's eighth wonder of the world, right? Compounding.
Right. So the average return 2 years out after you buy a 10% dip is 35%. What else do you actually need to know? If you only knew one stat about whether or not dips should be bought, that's the only stat that you need.
And then just pray for dips.
I love Tom Lee. Pray for more dips. It's not often you hear investors praying for a dip. But that is what guys like Tom Lee, that's why they set themselves apart from the average Joe investor. Tom has been in the game long time. Long enough to know that 5 or 10% dip in the market is a gift if you're a long-term investor. Or at least an investor with money to buy more stocks. Since the S&P 500's average return is 10.5%, long-term investors are willing to bet on history repeating itself, or at least rhyming in the long term. All right, one more chart to drive home the point about buying the dip, because listen to me, you should. This chart shows the 200 MA, and if you want to be a successful long-term investor and compound more wealth than you ever thought possible, you gotta buy the 200 MA dip. As I wrote my book a few years ago, Chapter 6, Building Your Portfolio, here's the quote. A good place to look for a dip is the 50-day moving average. But come hell or high water, if a stock on my watch list falls to the 200-day moving average, I will borrow money from my neighbor's cousin. In fact, I'll borrow money from my neighbor's cousin's little sister if I'm confident in a good buy. When the markets take a sudden dump, you have two choices. If you're a long-term wealth builder, you can borrow money from your cousin and make great returns, or you can panic, sell, and lose money. The choice is yours. All right, let's look at a real-life example. In modern history, actually. April 2025, Trump held the dumbest chart known to man, and he announced tariffs on all of our trading partners around the world. NVIDIA on February 21st was trading at 144. It fell below the 200 5 days later at 126. Then, under the 200 MA. So, obviously, when Trump is getting a little crazy, people are getting nervous, Trump does the tariff party thing, bam, it falls from 111 to 86. Now, you can panic and lock in that loss from 126 to 86, or you can borrow your neighbor's cousin's little sister's money and buy more at 86. So what happened? By May 25th, NVIDIA was back above the 200-day moving average, and you were already up 43%. But had you bought the dip, you would have been up 105%. So even buying at the 200, you'd be up 45. Buying from the bottom, you'd be up over 100. The point is, buy the dip. If you're a short-term trader, that's a whole nother bag of worms. You probably should already know your plan if you're short-term trading. What I'm doing is I'm sitting on the sidelines with my options trades, and I'm kind of waiting to buy the dip because dips are great. They're great for long-term buys and for big premiums on cash-secured puts. I do have a small hedge in the VIX going into September, but other than that, I'm just trying to be patient, and it's all about playing your strategy. So let's wrap it up. September is historically the weakest month for stocks, with the S&P 500 averaging a negative 1.2% decline, and again, only 44% of months closing positive. Losses often hit harder in the second half, especially in election years. Some sectors like healthcare can be good, gold can be good, but volatility in September is the norm. September can be tough, but understanding patterns can help you trade smarter. So what's your take? Drop a comment below. What's your September trading strategy? What are the experiences you've had? I'd love to hear from you. And don't forget, if you stuck it out this long, like and subscribe for more market insights. Thanks for watching, and I'll see you next week.
Thanks for joining me today on 15 Minute Money, the show where I search the financial world for the most up-to-date investment ideas, market trends, and income streams so you don't have to. I'm your host, Nick Bradley. We'll see you next week.